Welcome to StockOdds Odds and Ends. I'm Dave Singh here with Rob Friesen, trying to get ready for the week ahead. Good evening, Rob. How's everything?
Not too bad. Thank you. And got some interesting things to cover as we roll into a new month shortly. So as of right now, the futures are down already quite significantly in a follow through from Friday. I mean, Friday, basically we had a little bit of a volatility right after the open. It had every chance to get back over the previous day's close and do something with itself, but it failed. And then it was pretty good signal to noise ratio for the rest of the day, down, closing on the lows. So that didn't set up a, when you have a 15-minute or 30-minute rally at the end of the day, that can often bring it back up and alleviate a lot of fear. But when you close right at the low going into the weekend, it doesn't bode well for things to come. So, this whole thing started with, there was so much expectation really since June 15th. When we had the consumer, sentiment was down in the 50. We had the expiration in June. It was just, everything was terrible. But it's kind of where things turned, because we thought, well, okay, we're close to peak inflation, may not be getting a recession because the Fed might get a little bit more dovish with how bad things have gotten. And really from June 15th, well, 16th, right after that expiration, there was a nice move all the way until recently. And recently we had this expectation of Jackson Hole, which was kind of hyped. And, the speech that came out of there was, we're going to keep interest rates high for longer, and we're going to deal with this. And even when we get to our target, we're going to stay there for longer too. So markets weren't really thrilled with that. Now the bond traders have had it right. They've been already dialed in. And I usually say that bond traders are more savvy on the research and the, dialing in the odds on these types of things. And equities kind of tend to be hope springs eternal. Do you know what I mean? Because it's a buy side market. Equities is different than bonds anyway. And so it's like hope springs eternal. So, and the other thing is we had our 5-day seasonality window that kicked in on Thursday, right? So we could say that 5-day seasonality window kicked in and it overshot. Like our whole expectation for the 5 days was used up in one day.
Yeah.
And so then you're going into the next day, which is a Friday in the summer. Well, a couple of problems, light volume. Friday has risk for over the weekend. And there's a lot of stuff going on in the world right now. I mean, there is tons of stuff going on. So, you want a lot of weekend risk after you've already had a rally, after you overshot seasonality. And then, of course, to top it all off, this speech put a Debbie Downer on everything, and down we went. So I know you have seasonality for gold and silver supposed to be a little bit stronger for the first day of September. But here's my comment on that. I always look for things that either confirm seasonality or might argue with it. I didn't see silver and gold do too well here on Friday, and they're down again with the futures now. So that might, by the time we get to the first day of September, we may have enough divergence that it is a good play. So it's something to watch out for. But if the market keeps on moving down, it's taking gold and silver with it, right?
The dollar is getting stronger again, right? We're at almost a peak level here.
Yeah, I know the dollar actually made a new high here for this year, which is multi-year anyway. The previous one was 109.14. We are at 109.36, so we've already taken it out. It's completely blue sky until 2001 to 2002 highs, which is still a ways to go, and that was in the 120s. So that would be the euro low, and that would be the dollar high. But we definitely could head there, unless Europe's going to fight this decline in the euro and fight inflation by obviously raising rates. So what do you think?
I think they all have to follow now, right, to keep that stance of hawkishness. So higher rates.
They all got to fight inflation for sure, right? I had to switch screens here for a sec. Is it still coming through? All right.
Yeah, your audio's good.
Okay. All right. Let me run through the futures here real quick. We've got Dow Jones futures off 225 points. So this does signal a gap between when the futures stopped trading and at 6 p.m. Eastern when they started today. There's a gap down, and it's kind of in the middle of its range. So down 0.71%. S&P down 34.5 at 0.85%. NASDAQ 100 down 143.50 or 1.14%. Russell down 18.9, which is 1% exactly. And then we have the VIX has rallied up 1.79% up to the 26.65 to 27 level. So, we're definitely looking at a potentially down open. Now, the question is, does it continue to go down? I don't really, with what's coming with September, you can talk about that a little bit more, but, I don't really see a great argument for the markets to rally this week. Do you?
No, I mean, we, like you said, on Thursday, we kind of used up our potential energy for the end of the last 5 days of the August, and we're expecting the final day to be down, and the beginning of September is down as well. So it's like it's run out of steam.
And, I mean, it's on the back of a significant rally for the last, 2 months, 2.5 months, right? So if we hadn't had that summer rally, which we were expecting, we talked about it many times on our show. So we expected it. It was in our almanac for one, and we had this frothy expectation that the Fed was going to maybe be a little bit more accommodating, a little bit more dovish. I'm not saying you and I had that. I mean, I'm just saying that's the market. What market, collectively, the collective Borg had that. And so here we find ourselves after that rally with rolling over, and that's never good for people because we had that shelf that, whether you want to look at the Dow or the S&P, NASDAQ, whatever, we had this shelf which was all the way, from February when the war started all the way through, and we kept consolidating on that. And recently we consolidated a bit again there, and then we popped up on the Thursday, and then Friday it moves a little bit higher off the open and then pulls back, right? And down it goes. I mean, that was the Dow for sure. S&P a little bit less in terms of bullishness initially, but gave it all back and dropped below now. Now it would have to fight to get all the way back up through that consolidation area again. So this is definitely not looking good. And then, add into it, we can go to even one of our risk indicators that we look at that, had a lot of correlation and trades 24/7. That's Bitcoin. It's back under 20,000 as well. So that rally to 25,000 was pretty short-lived because it's all the way back down to 20 or below 20 now. So you're seeing this risk-off and we're going into September. Things are not looking good. In the Middle East, they're not looking good in the Russia-Ukraine thing. They're not looking good in the China-Taiwan thing. I mean, there just isn't a lot of, bright spots. Like the world is a wonderful thing, and we can all move to the city of Neom and live happily ever after. I mean, the world has got some serious problems right now, and it's going to take a bit to work through them, don't you think?
Yeah, and especially with energy. I mean, you got nat gas so high, Europe's going to get killed with energy hikes, and then winter's coming.
I know. I mean, we got, hey, crude is rallying tonight again. And it's had a pretty good showing recently, right? Since when did we kind of took off about the middle of August, and we started to kind of climb back up a little bit. Mm-hmm. And so Brent is now at it's higher than when I looked earlier. It's at 102 now, mm-hmm. Brent crude, so $102 a barrel, and that's up 1%, and it just keeps on climbing here. So I'm gonna shift my stance here towards. I have played a bit of oil recently, and I think I'm going to continue with that. I think that just the way that things are developing globally, we've already had that opportunity to factor in the recession, the global slowdown. Yeah. Things like that. We've kind of had that. We already factored in the lockdowns in China. But when you put everything together and you compare the demand that's definitely there. I mean, hey, the highways are full. People are living their lives. People want to travel again. Planes are flying. When you put it all together, we still have an oil supply problem, and I think OPEC's probably going to cut. And I think that we've got this consortium going on between Russia and Iran, and China, and it's not going to take much to put more squeeze. We already used our 80% of our strategic oil reserves. What else we got going on? I just think I think the landscape is getting really risky for a rise back to the highs that we saw in crude. So I'm gonna plant a flag with that and say I'm pretty bullish on oil. Is what I'm gonna say.
Good.
That's looking at all the global events going on. That's looking at supply chain. That's looking at the who's really controlling things and what it would take to shake it up a little bit more. And that's with the dollar climbing the way it is. We're having oil and the dollar rise at the same time. So if the dollar pulls back for whatever reason, it might be when Europe raises rates aggressively. Let's say they just suddenly do a 1% like Canada did, right? That's going to pop the euro, and it's going to pull, relatively pull back the US a bit. And so with that, you could see any pullback in the dollar could make commodities start to move higher, and oil is already fighting the counter trend of that, right? I mean, it's climbing while the dollar's climbing. So, okay, keep that in mind.
Interesting stuff. Well, almanac-wise, we have two events this week. The first trading day of September, which is on Thursday, and then we have the first Friday of September, which is, of course, on Friday. But for the month of September, we expect minus 0.28%. And for the first Friday, minus 0.17. So there are some sectors that could do better and some that could do worse based on the stats. Like you said earlier, silver and gold, chips, SMH, materials, XLB, staples, industrials, and discretionary might be better longs. And then things to be shorter are energy, XOP, XLE, according to the almanac, which is opposite to what you were just arguing. Then we have healthcare, financials, utilities, biotech, biotech, especially with the 10-year continuing to rise, that could be under pressure. XLC, real estate, XLK, XLF. So it's not very good in terms of most sector ETFs. So it is a kind of a bearish posture for the first trading day and for the first Friday of the month. And this goes all the way through options expiration. Mid-month seasonality is expected to be down as well. And the third Friday of the month, a minus 1.02%. So it's supposed to be pretty bearish. But then the last 5 days are typically up. And even the last trading day of the month is typically up. So expect kind of a bearish month, but those last 5 days could be a little robust going into November. And then in terms of,
you know what, I find something interesting. You said the GDX was like more shorter for the first day of September, where GLD and silver were more longer for the first day. I find that interesting. There might be some good pair trades there, or even like putting together, even just short GDX and long GLD. I mean, it sort of takes a little bit of the directional implication out of the equation. And whenever you can do that and make it on the relative performance, that's the healthier way to trade, rather than, taking an outright direction on a commodity or a stock, right?
Yeah. And even things like SMH and XLK, right? They're on opposite sides as well. So you could do some interesting pairs in terms of sectors or individuals.
That's true. Yeah, that's true. Okay.
But, economic calendar, there are some things this week. Let's see. On Tuesday, there's Home Price Index, the Case-Shiller Price Index, Consumer Confidence Index. On Wednesday, ADP Employment Report. Thursday, jobless claims and some ISM manufacturing stuff. And then on Friday, unemployment data again. So jobs, manufacturing, health of the economy, that's going to be some of the stuff that could influence some of the macro for the week as well. So if we get weakening data, maybe that's going to give the markets confidence that they won't be able to be as hawkish as everyone's expecting. But if the employment and the economy is just rip-roaring to the moon, right, like NASA's rocket tomorrow, then we can really expect those high rates to keep coming at us.
Right. So Euro area has the CPI on Wednesday. When's the rate decision, if they're going to do one?
That's all. I just have Wednesday there, and China on Wednesday as well.
Yeah, but we don't know if they're going to do a rate decision on Wednesday, do we? Euro? Like what day did you see what day it's scheduled for the ECB policymakers to make a decision on a rate hike?
They're expected to speak on Tuesday through September 2nd. So it's the season for that, but I don't have the exact date. Okay,
and then they got their CPI on Wednesday. I imagine they want to see that before they do anything. So it might be the week following or something. Okay, got it. All right. The U.S. 10 years already up to 3.10. See, the bond traders, they were pretty dialed in anyway, but they're factoring this what the Fed's got to do in, right?
Yeah.
Okay.
But we're still far away from that 3.5% level back in June.
And their target is 3.8.
I think so.
Yeah. Okay. Well, I mean, we said, the thing was, we always said the economy could withstand this, but the problem is that with the addiction to free money and all the stimulus and stuff, and it's not just a matter of raising rates, but it's also the inflation, everything hitting at the same time, right? Mm-hmm. So, I mean, they were basically, tackling things in a way that kind of exasperated the problem, because they may have been able to, had they not done so much stimulus, may be able to have bottled it up a little bit better, and we wouldn't have such a massive explosion of inflation. But it's not just too much money chasing too few goods. It's the devaluation of the dollar with all the stimulus and stuff that causes that too. So anyway, other countries have it worse because the stronger the dollar is here, and our dollar is strong right now because of flight to quality, safety, because of the world's situations, and that exports greater inflation elsewhere. So you think it's bad in the U.S., imagine what other countries are dealing with. Yeah. Like, for example, electricity, it's just gone skyrocketing in Europe. And like you said, it's not even the winter yet.
Yep.
So, I mean, it's been a hot summer, granted. Like, we've had, 44-degree temperatures in UK and Spain at the same time and stuff like that. So, it's been obviously air conditioning is, if they have it, is running where they have it. And so that's probably putting a bigger strain on it. But again, we haven't got into what if we go from, crazy hot summer globally, drought pretty much everywhere. Like, there's drought in China, there's drought in Europe. I mean, there's drought pretty much everywhere, US, right? So, and what if we go flip flop all the way to just the coldest winter ever?
Yeah. And
which could happen.
Stop a natural gas flowing into Europe. So,
I mean, if you go from the hottest summer ever to the coldest winter ever, man, people are going to go bonkers, honestly. Yeah. Anyway, okay, well, great talking with you. We got some ideas for this coming week here, and one is to be very careful of the riskier assets. The things that have no earnings, that are more speculative, that look at some of the recent earnings to see some clues to who's really getting pummeled, right? Where they're missing earnings, and they've got they're factoring in all these problems of why. That should give you some clues, and be more defensive and pair things up. You don't have to get directional exposure if you don't want to or don't need to, right? Okay.
Sounds good. All right. Good luck. Thanks.
All right. You too. Take care.